There are three coverage in topic of corporate governance, which are introduction, principles, and the importance of corporate governance. The collapse of major companies such as Enron, WorldCom, Maxwell, and other else brought public interest in corporate governance. Corporate governance is the corporate framework or structure that an entity applies to direct and manage its business and affairs. Through the corporate governance, the managers will be overseen and supervised. What is corporate governance? Corporate governance is a process and structure used to direct and manage business and affairs of the company towards enhancing business prosperity and corporate accountability. It is with the ultimate objective of realizing long-term shareholder value and at the same time taking into account the interests of other stakeholders. This is as according to the High-Level Finance Committee report on corporate governance. There are 6 principles that are applied in the corporate governance, which are transparency. Financial and non-financial information should be easily available in a company. Independence. Procedures and structures of company should be put in place to minimize conflict of interest. Social responsibility. A well-managed company should be aware of and respond to issues of social concern. Accountability. The decision makers should be accountable for what they have did. Fairness. All shareholders should receive equal consideration regardless of the size of their holdings. And responsibility. The directors should be liable for their performance towards their stakeholders. There are also principles that should be applied by the board of directors in ensuring an effective corporate governance. Good governance depends on effective interrelationship between board and management. Effective board is a board which is able to establish good stewardship, leadership, and control. The boards who works as a stewards or a person of responsible to take care of the company's assets should have a moral and statutory obligation to work with management to add value to those assets by contributing in various ways towards the organization. In the leadership elsewhere, an effective board will enhance the competitiveness of the company and shareholders' confidence. Effective board also will assure that the organization is trustworthy, honest, and incorruptible. The third component of principles and best practice for board of directors is monitoring or control. The company can have the best systems, procedures, and technology in place, but if they do not well monitor and control, the business is bound to fail. Continuous monitoring will also provide assurance of things that are going right and identify matters which need to be put right. Although the main objective of corporate governance is to realizing long-term shareholder value and at the same time taking into account the interests of other stakeholders, there are also other importance in it, which are the first one, identification of training and education needs for the directors and other key corporate participants. The second one, an entity should implement governance process to ensure those managing the entity properly utilize their time, talent, and resources to enhance business prosperity, accountability, and in the best interest of the stakeholders. The third one, which being considered as the aspect of business prosperity, in corporate governance, the ultimate goals is to ensuring the business is maintained with high accountability, business prosper, and enhance shareholders' value. Lastly, strengthening laws governing the shareholders' rights, directors' duties, and duties of other corporate participants. Why does an audit committee essential for the corporate governance? An audit committee is required on all listed companies and those seeking listing on Bursa Malaysia. It is also required on all federal statutory bodies and banks and financial institutions in Malaysia. Audit Committee is to assist the Board of Directors in discharging their duties relating to company, entity management and internal control, accounting policies, and financial reporting, and also be a line of communication between the board and the auditors. The Audit Committee is majorly needed for major frauds, strong criticism of the quality of executive management and the effectiveness of board supervision and financial institutions cause it necessary for action that strengthen accountability and corporate governance, so as to provide greater protection for shareholders and the investing and depositing public. The main role of an audit committee is to oversee the financial reporting and governance process, so as to monitor disclosure requirements, assist directors in discharging their statutory duties and responsibilities. The directors liable on preparing company's financial statements and audit committee minimize the involvement of board of directors. Thirdly, monitoring company activities, which are the ability to access the accounting records and indirectly monitor the company activities. The fourth one is increasing the public confidence in the credibility and objectivity of financial reporting. The financial statement is free from any bias. Lastly, supporting the audit function. An audit committee becomes closely with the whole audit process and it will strengthen the auditor's independence. Lastly, problems of an audit committee. The first one, conflict in executive decision on operational matters. Secondly, committees use window dressing to comply with Bursa Malaysia. Thirdly, board is distant from financial matters and the external auditor. Lastly, legal liability of audit committee members.
Types of fraud. The types of fraud are fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting are manipulations, falsifications, or alterations of records or documents, omissions of transactions such as the legal suit is not disclosed in the notes to the account, recording fictitious journal entries, omitting recognitions of events and transactions, and inappropriately adjusting assumptions and changing the judgments used. Misappropriation of assets is a theft of an entity's asset and is often committed by the employees. For example, stealing the physical or the intellectual assets of the entity, using an entity's asset for personal use, and the manipulations of receipts, where the money does not tally to the total in the receipts report. Assessing the risk of fraud. An auditor needs to obtain reasonable assurance by having professional skepticism, risk assessment, and detection. Risk assessment. At the planning stage, auditors should assess the risk that fraud and error may cause the financial statements to contain material misstatements. These are the events which may increase the risk of fraud. Internal control, poor, good, or ignored by management. Questions with respect to the integrity of management. The integrity of management may be dominated by one person or no effective oversight by board, high turnover rate of financial personnel, frequent change of auditors. Unusual pressures within the entity. Industry declines and failure are increasing. Inadequate working capital. The entity heavily depends on one or two products only. Unusual transactions, such as bank transactions, related party transactions, or payment for services such as lawyers that appears to be excessive. Problems in obtaining audit evidence. Inadequate records, excessive adjustment, transactions are not recorded, and lack of proper authorization. The roles of auditor in risk assessment are: discuss among team members the indication to material misstatement in the financial statements of audit client, obtain understanding of client risk of misstatement due to fraud, and identify whether accounting and internal control systems of an audit client has put in place to address such risk. Obtain knowledge to audit clients' understanding on importance to have a good internal control system to prevent and detect the fraud. Determine whether the audit client has the knowledge of any actual or suspected fraud, and discuss with those in charge with governance regarding the potential fraud of the entity.